All right, let's see if we can get this working. Just a quick welcome to everybody to this Business Essentials webinar series. I'm Adam Crowley. I'm the head of real estate and construction at RSM, and joined today by one of my co-presenters, Sam Mohammad, our head of indirect tax and a partner in RSM. We've got a bit of a discussion today on an area close to my heart around property and construction, in particular some trends in the development sector, some of the things we've been seeing of late in terms of activity of our clients, contacts of ours in terms of trends that are occurring in the space, together with some structuring considerations we've recently been working on, and maybe just to give everybody a bit of a guide as to what's available out there and what transactions and structures are coming into being, probably due to some of the trends that we're seeing, and just some sort of feedback on that. Touching on recent changes in foreign ownership, surcharge land taxes, and then given that it's this time of the year, we're coming into 30 June, it's that 19 days or so to go, we thought we better touch on some year-end tax planning just to make sure people are thinking about what they need to do between now and the end of the financial year. There might be a question function within this. If you can use the Q&A or pop any questions in, happy to kind of take those as we go at the end of sort of each of the agenda items. So kicking things off, here we go. Recent trends that we're seeing in the development sector. So the first one I wanted to touch on, given all the turmoil we had with interest rates and coming out of COVID and construction costs, we've really seen a change in developer behavior. What used to be quite sort of isolated, I'll call them silo transactions, in which you had landowner, developer, and funding all really coming from the same group or entity per se. We've seen a lot more activity in what I'll call combined arrangements, and this is connecting different segments of that sector, be it landowners, separately with developers, separately with capital and or funding. So be it because we're trying to manage risk, be it because feasibilities that might have once been doable on sort of a standalone basis have become less viable. Parties are really combining forces under different joint venture arrangements, combining both landowners, developers, and capital funding, each from separate third parties, to bring a transaction together. So a lot more activity in what I'll call sort of the joint venture space. And RSM's been quite active in connecting clients in that area, be it connecting landowners to developers, to capital funding to get projects to proceed. So given the complexity of some of those arrangements, some of which I will touch on, there's obviously different tax, duty, and structuring elements that come into play on those transactions, given the multi-parties with different interests under the development and looking for a different return as part of that participation in the arrangement. Separately, we've been involved in a lot more, I'll call it contractor due diligence or builder due diligence. So everybody's probably seen over the last couple of years, contractors and construction companies have had a lot of, we'll call it financial stress going through the sector. And as a result of that, developers are a lot more cautious as to the parties that they're contracting with before undertaking any kind of development. This used to occur a lot more on the larger end of town, but we're seeing this really filter down to smaller and mid-market developers as well, in which a lot more due diligence is being undertaken of their builder and their contractor. So financial viability, sort of stress testing of the builder and their ability to see a project through to completion. Whereas once before that might have just sort of been assumed in many cases, developers are being a lot more cautious around who they're engaging to undertake and construct their projects, with cost just being one element, not the element that is ultimately considered. So just because somebody has come in perhaps cheaper on a tender doesn't mean that they're perhaps the front runner on the engagement. They're looking for the party or the builder that's going to see the project through to the end into completion to ensure the viability of the project. So a lot more diligence in that space. Single project development focus. We act for developers on the large end of town and the small end of town, and everything in between. One of the behaviors we've seen quite a bit of, and I think it's namely attributed to sort of managing risk at scale, is what I'll call single project focus. So it might have been the case previously that we'd have developers who could have 5, 6, 7 different projects on the go at any one time, notwithstanding that they're, say, a mid-market developer. That's really scaled back, and they're really focusing their attention on single standalone projects, seeing them through to completion before sort of rolling on to the next, as opposed to having multiple projects on the go at any one time. I think that has caused some slowdown in the amount of projects that are being seen through to completion. But everybody is a lot more wary and cautious in terms of the development projects that they're undertaking, and sort of seeing them through to completion on a single project basis, in sort of a lineal fashion, as opposed to having, maybe 5 years ago we'd have clients with 7 or 8 projects on the go all at the same time, and it's definitely a risk-off behavior as of late. I've touched on this on the combined arrangements earlier, but joint ventures are becoming more and more common to try and spread or mitigate risk. And this is even, we've been involved in different joint venture arrangements between different development groups. So a particular developer might have a particular project on the go, or had secured a particular site and is now wearisome on seeing the project through to completion on a standalone basis, and is saying, well, perhaps I can bring in another developer to kind of share the risk to undertake this project together. And so a sharing of that, obviously a sharing of the profit, but a sharing of the risk associated with the project as well. And then finally, without too much surprise, costs increase, impacting commercial viability on some of these projects. So it's something that looked good a couple of years back that we've optioned up and had lined up to commence. The feasibilities potentially no longer stacking up, and those being sort of put on hold, or parties looking to offload sites where the return compared to the risk is not within their, outside their risk appetite, I guess I would say. So we've seen a lot more stress testing on the commercial viability of projects. Hopefully with interest rates starting to calm down, there's a bit more comfort in the market to proceed forward with some projects, but definitely this financial viability piece on costs alone is seeing a slowdown. I'm just going to jump off this. Now, I touched on these combined arrangements where parties are coming together to bring the landowner, the developer, and the financier into the structure. And I'm just going to touch on 2 structuring elements that we're seeing from clients, and one of which is probably just an example of where poor structuring or not thinking things through ultimately leads to what I'll call tax inefficiencies, and kind of forces you into a situation in which the recycling of your sort of profits or reinvestment of your profits is causing you a potential tax issue just based on the way that your arrangements are structured. But these are very commonplace, and so we see it all the time. The ATO is aware of it, and it does get quite a bit of attention. So helping clients through that. And the second is some more complex structuring under this combination of landowner, developer, and financier. So I'll talk a bit less and maybe show you some pictures. Now, when we're going through these structuring considerations, clients always say to us, what's the best structure? And I think our response usually is, there is no best structure. You should really start thinking about the way you structure your property developments or investments in terms of use of entities, use of capital, and the way these things are structured, really just as tools in the chest in your toolbox. So depending on the outcomes you're wanting, depending on whether you're pursuing sort of growth or yield, thinking about what your financing structure looks like, or your serviceability of that financing looks like, will dictate the types of structures that are used in relation to that property development. Again, whether you're wanting to construct and sell or build and retain will also have be a factor that we consider. Asset protection and risk management, again, key consideration, particularly in terms of how you're owning the land holding versus undertaking the development compared to who has the financial risk or is advancing funding, and what is the security for that funding. Holding costs come into play as well. How long is this going to take, and how are we dealing with holding costs as part of the process? Flexibility. So at the outset, sometimes we're talking with clients and going, what's the intention for this development? How many investors are coming in? Are we going to develop and sell everything? Do we want to hold and retain any part of the project? It could be a multi-stage project. Are we wanting to split the projects up? And so thinking about how much flexibility we want through the structure, knowing that we might want to pivot at any point in time, is a key factor in terms of how we structure the arrangements. Simple versus complex. In my view on this, you don't need to make the structure any more complicated than it needs to be. A lot of time clients get into arrangements where they've got these big, wild, complex structures that are perhaps unnecessary, and the opposite of that being, in certain circumstances, it makes sense to have a complex structure because we're trying to achieve a particular outcome or give effect to some sort of asset protection benefit or manage holding costs as part of the process. And then finally, once we've considered all that, then we think about tax, and so I'll call it tax efficiency, particularly on not only the development or through the project, but also the retention of profits and the reinvestment of profits post completion of that project. So I'm going to assume most on the chat or on the series today are kind of familiar with the different types of entities that ultimately get used in different development structures, and the sort of their tax attributes that flow from them. So individuals, pretty common, pay tax at quite a high rate, and get access to a CGT discount, and can utilize prior year losses without too much issues. But obviously there's unlimited liability being an individual at play or involved in an arrangement. So not common that we'd see an individual undertake a property development personally in their personal capacity. Companies, most people are familiar with a lower rate of tax, no CGT discount. They do have the ability to utilize prior year losses, but they are subject to some tests. They can retain profits, and they do retain losses. Moving to the right, unit trusts, very common also. They tend to be fixed in terms of the distribution of profits to the unit holders. They can utilize prior year losses, although they're subject to particular trust loss rules as well. They are able to get the 50% CGT discount, so they do tend to come into play where there's an intention to hold an asset for a longer period of time and allow the availability of a CGT discount in the future on sale. They can distribute profits, so they don't typically retain profits, but they do retain losses. Discretionary trusts, much of the same, except that the owners or beneficiaries of those entities are variable, so they're at the discretion of the trustee as to who the income is ultimately distributed to. And then partnerships, which are basically transparent for most income, losses, liability, although I think they're recognized as separate entities from a GST perspective, Sam, but I might let you touch on that at a later point. So these are just the entities and some of the attributes that they have. And so when going through different arrangements or the pros and cons of the use of each of those sort of entities as part of a property development or a structure, we're really weighing up the pros and cons of each of those elements. And there is ultimately no best structure. It's just picking and choosing which elements we want to achieve particular outcomes having regard to those attributes. So be it asset protection, be it wanting to retain and reinvest profits, make it easier for servicing third-party debt, or making it more investable for third-party investors. All of those will weigh into the arrangement. But one thing we see a lot of is taxpayers or developers setting structures up where they've only thought about the immediate project in front of them, and perhaps not thinking a few steps down the road as to how they manage not only their tax affairs, but how they reinvest the good work of what they've achieved into, say, the next project. And they tend to fall foul of I'll call it on-lending arrangements, which ultimately can cause them to come unstuck. So enough words, and I'm going to do some pictures because I think this is sort of helps spell this out. And it is an area we're seeing increased ATO activity on. I think it's just because of the way a lot of development groups are structured. It always comes up that we're trying to manage these loan positions cross group, but I'll give the example, and people can comment on or raise any questions. So quite often in a develop and sell sort of strategy, people will set up a discretionary trust, or it could be a unit trust to acquire the site. And usually what we get told is, well, we've used the trust because we want to get a CGT discount. And the immediate response to that is, I'm not even sure we're in the capital gains tax provisions if this is sort of a develop and sell. So usually the revenue recognized is on revenue account, not necessarily a CGT discount. But putting that aside, a trust is set up and money's tipped in either from investors or could be from a bank, and the site's acquired. And the entity undertakes the development, ultimately makes profits, and we decide where we distribute those profits. And that's flowing back to, in this example, say a family or that's controlling the group, or some individual investors. Ultimately, if the income is flowing to individuals, we're paying the highest rate of tax on those earnings. So what tends to happen is they say, that's a bad outcome. We don't want to pay that much tax on these earnings that we've made, particularly when we want to reinvest them into the next project. So they end up speaking with their accountant and they say, hey, we're going to use a bucket company or a corporate beneficiary, and we're going to start to distribute some of that income to that corporate beneficiary, which will actually cap the tax depending on whether it's a base rate entity, somewhere between either 25% or 30%. Disregard the 26% on the slide there. So we've reduced the tax on reinvesting those profits by distributing them to a corporate entity, and then we're going to go do the next project, and we're going to have our corporate beneficiary ultimately lend money to our next project entity. And this is where the issues start, because those loans from that corporate beneficiary to that discretionary trust fall within the application of Division 7A, which treats those loans as potential deemed dividends. And so where clients or taxpayers can come unstuck is they've got multiple entities or developments on the go, and they've made profits from those developments, but we're wanting to try and cap the tax on the earnings, but also reinvest the earnings into the next project. And so the issue that you're causing here is you're going to force yourself to ultimately end up in the highest rate of tax by having to either deal with those Division 7A loans, charge interest, or make minimum repayments by way of dividends. So your total effective tax rate overall starts to become 47%, because we're perpetually chasing our tail managing these Division 7A loan problems. And this is an area that is highly looked at by the ATO. So later on, I'll just touch on dealing with Division 7A at year end, but this is only coming about just by virtue of the way in which the development is structured. And so if we're speaking with a client going, what are we wanting to do? Where are we wanting to take the development group to? How many more projects have you got in the pipeline? We would ultimately be perhaps hesitant to put them into a structure like this, notwithstanding the asset protection benefits or the flexibility it achieves. It could be done differently to then just manage this issue so it doesn't arise. So I've touched on these. So structural issues, it is the structural issues that are causing the tax inefficiency, and it can otherwise be mitigated just by changing the type of entity used in the structure, or the combination of entities used in the structure. A lot of the time, the ATO is also focusing on documenting those loan arrangements, so making sure that they're compliant Division 7A loan agreements, making minimum repayments. So if I've advanced all my capital into a project that's got a Division 7A loan, it's money out. I don't have any revenue coming in. I don't have any sales. How am I going to meet the minimum repayments under that loan? Right? I'm forced to ultimately end up paying dividends, particularly if the timing of my sell down of completed projects is not lining up with when I need to make minimum repayments on that loan. Section 109R applying, which is effectively arrangements where people repay the loan before year end and then redraw the loan shortly after year end. So that would be happening about now, and money coming back out in July. Those repayments are not effective for purposes of Division 7A. They're treated as if the repayment had not been made. So be very, very cautious of the application of 109R and repayments and redrawing under purported new Division 7A loans. Another area that's getting a lot of attention is repayments being made by the wrong entity. And so it's on the taxpayer to evidence that a repayment is being made by the person who has taken the loan. So payments made by third-party entities sort of directed at the direction of the borrower are complicated, and the onus is on the taxpayer to evidence who has made the repayment and that they're a bona fide repayment of an existing Division 7A loan. Moving on from that, I mentioned that we've seen increased activity on a combination of landowner, developer, and we'll call it financier. And quite often, these sorts of arrangements are structured under what's known as a PDA. They've got a couple of different names: Project Delivery Agreement, Property Development Agreement, amongst two. And really all it is doing is combining the landowner, the developer, and the financier into a contractual arrangement to undertake the development, where they all don't have an ownership interest in the land. They've got different legal rights in the land. Some are contractual, some are mortgage rights pursuant to the financing arrangement, but they're not all owners. And broadly, they end up being structured as some landowner, could be a trust, could be a corporate, owns an asset and wants to engage with a developer to help them undertake a development in relation to that asset. And so these project delivery agreements or property development agreements are entered between the parties, between the developer and the landowner, where typically it could be an advance of funding up front in the form of a loan from the developer. Could be just the payment of a development fee for the right to develop the project, but putting some cash in the hands of the landholder, so there's some level of comfort on their end that they've got some money up front in relation to the arrangement. We typically have a financier come in, that'll take I'll play this the whole way through, have all the pictures involved. There should be over to the right here an entity for financing, but ultimately that provides the construction loan and takes a mortgage over the asset. The developer usually has a second ranking mortgage over the asset, as well as powers of attorney and whatnot to allow them to effectuate the sale and any kind of applications that need to be made to council. But effectively, the developer is developing the land owned by somebody else, or developing the asset owned by somebody else, in return for the payment of a development fee. And the funding of that development fee is occurring out of the sale proceeds from the sale of the property. So you have a financier who is providing the funding for the arrangement, who has got security over the asset, and they're providing funding to the developer to allow the developer to fund the development of somebody else's land. The developer does not become the owner of the land, but the developer is receiving ultimately a fee paid by the landowner out of the sale proceeds that come from selling off the completed assets. Now, these are not new. Project delivery agreements have been around forever, or for a very long time. They're probably caught more favor of late because you've got different parties that are coming to the picture with different expertise and wanting to, what might not have been a viable project had the developer had to go get their own financing and had to pay considerable money up front to acquire the site, which might make it no longer stack up commercially, can now still undertake the development without having to come up with that upfront purchase price, and therefore starting to make arrangements more viable. So very, very common in New South Wales. Sam will confirm me, but don't believe we have a duty issue in most instances. Queensland, Sam, I think we're
Queensland's
okay.
okay. New South Wales is okay. It's really just Victoria, which effectively treat that PDA arrangement as, I'll call it a synthetic interest or economic entitlement between the parties, which more or less deems a dutiable transaction as between the landholder to the development company, to the point that the development company is seen as acquiring a 100% value of the land, minus potentially a discount for whatever interest is, I'll say, economically retained by the landholder. So if there's a 70-30% sharing arrangement between the parties, then potentially the development co, which has got the 30%, may be seen as acquiring a 30% interest in the land, but that's on a submission to the Commissioner of State Revenue in Victoria. So certainly it's it's an unfavourable treatment in Victoria, but the other states haven't yet gone down the path of following Victoria.
Yeah. So quite common, particularly where we're trying to manage a duty liability as well. And if you compare this to the counterfactual of the developer borrowing all that money up front, acquiring the asset, paying duty, and then having to get further financing to fund the construction and development of the asset, that could be a much more difficult proposition and a much more costly proposition vis-a-vis an arrangement like this, where we're not having to come up with that large outlay up front, and there's no, typically, at least in Queensland and New South Wales, and I'd have to check WA and other states, but typically no duty liability up front, as there is no acquisition that is occurring. And if you're looking at calculating what's my total IRR as opposed under this sort of an arrangement, you're looking at not a lot of cash flows out up front compared to cash flows up front to acquire the site, and then looking at what the development return is. Now, the overall return to the developer might be less, but on an IRR basis, it's often higher, because we haven't had to come up with that initial funding piece up front, nor incur the duty cost, and the access to financing is typically better because the financier is still getting their first mortgage interest over the land and has a level of security. So very, very common. Those arrangements, I'm just going to play this the whole way through. They can be simple, or they can get much more complex, where you've got landholders in consolidated groups that ultimately enter into project delivery agreements with partnerships that undertake the development in partnership, with financing involved as well. So there you can go from simple to complex. There's different tax elements that flow off a kind of partnership arrangement, a developer in partnership entering into this sort of an arrangement with a landowner, that spin off the back of this. But these sorts of arrangements can be simple, they can be complex, and again, I guess it depends on the involvement of the third-party developer, whether the landowner wants to remain involved in the project and take some upside from a development perspective, and also what's the appetite of the financier in terms of their capital stack into the arrangement as well. So quite common. So with all that said, what are we seeing in the market of late, particularly in relation to these combination arrangements or project delivery agreements? So Sam hit the nail on the head up front on this economic entitlement issue in Victoria. Again, not new, but what would an arrangement that wouldn't have otherwise been dutiable in New South Wales or Queensland is going to be dutiable potentially in Victoria. So being alive to that issue. A recent case of Moreton, where a developer came to a large farm holding individual that just had held farmland for a very long time and said, "I'd like to develop your land." Historically, the position from the ATO was, well, even if you're perhaps a passive landholder, at the time you start to venture your land into this project delivery agreement with this developer, you're no longer holding it as a CGT asset, and you're starting to hold it on revenue account. And ultimately, the Moreton case, which I think is going to be appealed, but I haven't seen where it got to in terms of being on appeal to the full federal court, but ultimately said, well, no, if I'm owning this asset as a passive landholder, and I'm merely realizing the sale of my asset in the most advantageous way, but I'm not going so far as to carry on a business or undertake the development myself, and I'm really having quite a passive role in this sort of an arrangement. Moreton was successful in arguing that the profits that they made, or the gain they had realized on the disposal of this developed asset, in this case it was subdivided land, was a CGT gain and not a revenue gain. And that was relevant because the asset at the time was a pre-capital gains tax asset. So obviously the tax treatment, a lot turned on it for the taxpayer. So it's an interesting case. And I guess it evidences that just because you're a landowner and you're going to enter into one of these PDAs with a developer doesn't necessarily mean that the profit that the landowner might make is on revenue account. there are instances where the landowner could still make a capital gain. Now, if they do venture it from being a CGT asset into becoming a revenue asset, you do have to manage CGT event K4, which just deals with changes in CGT assets moving over to becoming trading stock, and we can make elections as to whether that gain occurred at market value or we inherited cost base. But something to watch out for, particularly the appeals to that case. Potential formation of a tax law partnership. So what would otherwise be a contract for service for development of someone else's asset, the ATO has taken a good hard look at, is your project delivery agreement really just giving rise to a tax law partnership, a partnership between the landowner and the developer? And there's been some recent private rulings which have come back unfavorable from different taxpayers to the ATO, where the ATO has gone so far as saying, we think we have a tax law partnership here. Now, that has a lot of different issues that spin off the back of it from an income tax and GST perspective as to whether or not someone's effectively sold potentially half of their asset into this partnership or ventured the asset into this partnership, that can cause issues. So something to really be careful of in the drafting of these project delivery agreements as well. One that we've seen pop up and had to turn our minds to is whether or not the PDA, if it did give rise to this partnership, actually gave rise to a beneficial interest in the land following the changes in the duty provisions for changes in beneficial ownership. I might pause there, Sam, if you wanted to add anything into that, but just to be wary of, because of the introduction of these provisions, I guess, if it does go so far as giving someone a equitable interest under a partnership in land, is potentially dutiable in New South Wales, for example.
Yeah, so New South Wales and Victoria are probably the two leading states with the beneficial ownership provision. So any development in those two states, you need to be extremely careful that granting rights above and beyond what I guess might be otherwise needed could potentially give rise to a change of beneficial ownership and an unexpected duty outcome.
Yeah, so careful drafting seems to be pretty critical to that. This is a little bit more remote, but the potential existence of a non-share equity interest under Division 974, I won't go into that for present purposes, but needless to say, if I'm a developer and I advance a loan to an entity up front, that's the landowner, and I ultimately get paid a return based on the profitability of the landowner in relation to the sales that they're making, and I'm paid a return for both doing that work, but also for advancing that financing up front. The question is, well, is that a financing arrangement where I've got a contingent return that is being paid back to me? And does that start to look like non-share equity under Division 974, which if that were the case, it'd be quite bad, because the development fees are ultimately paid, could be akin to a dividend and non-deductible, and could also have landholder duty issues as well, at least in New South Wales. So perhaps a remote issue, but nonetheless something that we're been watching carefully. And finally, development fees being construed as a profit share. So there's one thing to calculate the amount of your fee based on sort of a waterfall payment to go, the amount of the fee that I receive is sale price less construction costs less landowner retention is how I calculate my fee. But all too often we see arrangements where the agreement says, I'm going to do this work and I'm going to pay you 50% of the profits. And that looks like sharing in profits and not a fee calculated with reference to some kind of formula. And therefore the payment by the landowner could be viewed as being non-deductible. And I think, Sam, could also look like a partnership.
And so, yeah, definitely. No, we have actually seen instances where the residual after, as you say, through the waterfall, you start off with essentially your gross proceeds, deduct for GST, deduct for sale costs and so forth. It's the residual that generally creates the problem of what happens with the extra amount. And if it says words to the effect of, the parties share, or, both parties have an interest in that residual, there's a real risk of a partnership being in existence.
Yeah. So again, I think the message to probably take from this is PDAs are great. The drafting is critical. And you're not just dealing with the legal rights under those PDAs, but there's all the peripheral issues on income tax, capital gains tax, GST, stamp duty that flow from the arrangement. And so careful consideration from, I guess, from a tax advisor or for a lawyer as part of this process for the input into that document is critical, because what might be viewed as okay from a legal perspective to say, we're going to pay you 50% of the profits would be catastrophic potentially from an income tax and or duty perspective. So care is needed. I'm going to stop talking for a bit and maybe throw to Sam to talk about what we're seeing in terms of surcharge duties and land taxes.
Yeah, thanks, Adam. Just before we move off the first topic, which is around structuring, one final point to note, and like every good tax question, the answer is it depends. And one of the things, even from a tax point of view, you may not get all of the wins that you would like with whatever the structure that you have. Just yesterday, I was speaking to a potential client who's got a series of unit trusts and discretionary trusts through the whole structure. And that was, I won't say set up for land tax purposes, but it was certainly set up with a view in mind of accessing various or additional thresholds. Now, that might give you a beneficial outcome from a land tax perspective, but to Adam's point around Div 7A and various loans, there is a potentially much larger issue at play. So you almost have the effect of saying, well, I might win on one thing, but potentially I don't win on something else, and you just have to kind of weigh up which is the thing that you'd rather get the win on rather than necessarily trying to achieve all of your objectives. So looking at surcharge duties and land tax. So what I've sought to do in this slide, and I appreciate there's a lot of detail in it, and maybe if we just kind of take a step back with surcharges generally, we're almost at the 10-year anniversary of the first ever foreign person surcharge. So that was in Victoria back in 1 July 2015. And at the time, the original intention or the original objective behind it was to really free up predominantly residential stock, more for, I guess, Australian-based individuals and companies as opposed to foreign owners. There was I guess, a bit of a thought 10 years ago that there was a lack of particular land stock, and that not necessarily foreign persons were contributing to, the revenue base in the same way that, people who are local and spend local contribute to the local economy. So that was the original intention. And when you consider that the original rate for foreign person surcharge in Victoria, which was the first one, was 3%, and you look at it now and you're thinking it's 9%, looking at it objectively, you might consider whether, in fact, those original thoughts or objectives behind the surcharges still hold true, or whether we've moved on from simply being a way for which foreign persons contribute to the local economy to now being more in the nature of revenue raising. I've gone through a few of the explanatory notes to all of the implementing or amending bills. I haven't seen revenue raising mentioned as the reason. But you can probably draw your own conclusions in terms of where the rates are to where they used to be. Perhaps unrelatedly, foreign persons don't usually vote. So there's probably something in here to say that those rates that exist now, which again are up to 9%, I'm not sure they're going backwards anytime soon. So one of the other things to note is various states, particularly Queensland, Victoria, and New South Wales, seem to have a race amongst themselves to either catch up or get ahead. Queensland recently updated its rate from 7 to 8% so that it was in line with New South Wales. New South Wales then said, well, fine, we'll make ours 9%. So where these rates end up, who knows? But they have certainly not gone backwards over the last 10 years. Now, in the slide, I haven't put all of the remaining territories as well. I couldn't quite fit them in, but you can get a broad sense here that the base as to who is considered a foreign person is slightly different, which is unhelpful if you're trying to work out whether you truly are a foreign person or if someone you're advising is a foreign person. But the flip side of that is it kind of keeps Adam and I in a job. So we're not overly disappointed that there is some level of complexity in terms of working out who a foreign person is. Now that being said, it is a very fundamental and important issue if you are looking to sell or looking to buy land, that you make sure that this issue as to whether you're a foreign person is considered. A few reasons for that is the dollar values involved are often quite significant, and the revenue officers have all sorts of data matching that they can use way down the track. We're talking a 5-year amendment period to determine. So we're seeing significant numbers of, I'll say, retrospective assessments being made where various revenue officers, predominantly on the East Coast, are looking at things like immigration information. They're looking at declaration cards at when you land and when you leave. All of that information plays into whether you're a foreign person. And that can be considered years and years down the track. So the fact that you might have got your original transaction through without any surcharge is not a guarantee that that surcharge can't be imposed later. For those people who have a form of punishment of reading foreign surcharge cases, Commissioner wins every time. These cases are purely fact-based. The fact that you may not have been in the country for X number of days and you're 1 day short, or you hadn't got the visa in on time and you were 2 days late, none of that matters. There are no questions of fairness in any of these surcharges. It is a very binary, black and white. You're either a foreign person or you're not. Some states are more difficult than others. So I'll say New South Wales is more difficult in the sense that you're essentially assumed to be a foreign person unless you can prove otherwise. So generally speaking, you'll need, if you have a holding structure through a discretionary trust, you'll generally need an exclusion clause, which has to be irrevocable. Other states, not quite as onerous, but at least the rules are black and white in New South Wales. Queensland, for instance, it's not as clear. So they look at things like historic distributions to make a judgment call as to whether a particular trust or company is seen as a foreign person. But to actually determine the issue can be quite complex, because ultimately you've got to trace through multiple entities, work your way through all the way to essentially an individual or series of individuals. So without going into each of the definitions, they're on the slides. You can see the surcharge rates. Generally speaking, they're being updated fairly regularly. So again, I don't see those rates going backwards.
Sam, two quick ones on this. I will jump to the question that we've got in the chat here, but the one that seems to trip a lot of people up is individuals where there might be one foreign person, but they're a relative, and then so they get caught in on an associate inclusive sort of basis, which is catastrophic.
Yes.
And the other one being people who have no connection whatsoever to any kind of foreign entity or person, but because they've got a discretionary trust and it could potentially distribute to a foreign person, are kind of caught. And a lot of these cases that we see are just people who haven't amended their trust deed on time, unfortunately, and sort of lose on that front. I will just touch on this question. So just got a question through. So development fees, is it possible to have a fixed base fee plus a discretionary incentive bonus that is agreed between the landowner and the development entity only at completion, and hence not construed as a partnership? So quite simply, most of the agreements are structured as the developer gets to receive all of the sale proceeds, less construction costs, less an amount that is going to be retained by the landowner, and then a percentage ultimately being applied sometimes to the balance, or just with them receiving the balance. And that landowner entitlement, or the amount of the retention for the landowner, that could be a fixed amount, or it could include some kind of variable amount. But what we're trying to move away from is the view to it being sort of a profit share outcome. So a calculation to say you receive X amount plus an amount if the IRR exceeds Y. All those elements are usually quite common and can be factored in, and doesn't automatically follow that because careful drafting is needed, but doesn't automatically follow that it's a partnership just because it has this waterfall. In fact, all of them, I think, Sam, that we've seen are structured in that manner. And what you're trying to avoid is things that go, you receive 40% of the profit and I receive 60% of the profit, or we're going to share the profit equally between the parties or something like that. So really it starts with gross proceeds, less GST, less holding costs, less development costs, less whatever. Landowner retention is the calculation of the development fee. So hopefully that answers the question that was raised. Happy to, if anyone's got any other questions, you want to put them in the chat, happy to discuss. All right, we've got another one. This one might be for you, Sam. Looks like a surcharge question. So I had a case, a self-managed super fund, one member not lived in Australia for more than 200 days. The fund's property is charged land tax, has been charged with land tax surcharge. Is there any option? Probably need more facts than that.
Yeah, there's probably a few more facts I think needed, but if the question is coming down to around the 200 days, like I said, it's a binary question. But if the question is whether the fund is seen as a foreign person, then yeah, I think there are a few more facts to be obtained.
Like clearly, which state?
That's true. Yeah, sorry. I think I assumed New South Wales with the 200-day reference, but yes, that's right.
Second question. So in a PDA, the landowner will be the vendor. Yep. If so, it seems a bit risky for the landowner if there's building defects. So that's usually covered by warranties under all the contractual agreements. And I guess the counterfactual to that would be, if I own the land, if you look at the risk between the developer and the landowner, if I own the land and you're developing on my land, I get the benefit of this asset that you're building. Now, I've got contractual obligations to make payments to you, but in terms of default and whatnot that might arise, there's a fair bit of risk here being taken by the developer because they're building something that they don't own. So depending on how it's balanced in terms of the contractual rights under that agreement, there's a fair spread in that arrangement. I think the question was, what happens if there's defects in relation to the building and the sale of that asset? Again, covered by the contracts with the builder. Like if you were a homeowner and you had some builder build your property and then sold it, we go pursue the builder. And again, usually dealt with by the any kind of guarantees or warranties that are dealt with by the developer. So super common. I think some of the bigger ones we've seen in the PDA space, Sam, have been things like big land subdivisions, for example. So probably more common in that space where you've got someone who's got a really big asset and there's a means to either chopping it up and selling it in an efficient manner. So there's only so much damage you can do to land once you put the infrastructure in. So sometimes managed. I've opened the floodgates now, Sam. You're going to get everybody's
right.
Am I a foreign person? We should have a game show. Am I a foreign person for surcharge? So if a natural person is an Australian citizen, but as a non-tax resident, how's that treated in Vic in New South Wales? New South Wales, they're fine.
Yeah, I think in Vic you're fine as well. I think citizens across the board are always going to be non-foreign.
Yeah, and in some instances, New Zealanders, but
yeah. With certain visas, yes.
Yes, yeah. All right, I'll move on to just cognizant of the time. I'll move on to the next one, Sam. Maybe I've jumped.
Yeah, I'll keep this one. I'll keep the land tax pretty quick. Look, it's a similar concept to what we were talking about before with stamp duty, that the rates themselves have significantly shot up over recent periods. And when you overlay that with the significant increases in the underlying land values, land tax itself has been a significant cost to a lot of landowners. Now, whether that be passive landowners or active landowners, the way that plays out is how do you then go about recovering your investment? So if you're if you own a building and you lease it out, how do you then pass on that cost, particularly in some states where there isn't a statutory ability to pass on land tax? Do you have to somehow build that into your future rent? But in other cases, you may be able to pass it on under the terms of the lease. And look, again, these rates are not going backwards. You look at New South Wales, it's gone up from, I think, 2% originally. It's now 5% in the space of a few years. So that's really all I wanted to point out on the rates. Sorry, one other point to note is Queensland and Victoria have a wider surcharge land tax base than the other states. So whereas historically all the other states just impose it on residential land, Victoria and Queensland impose it on all land types, whether that be commercial or industrial or residential for that matter.
Sam, and this is in addition, I think there's something that gets confused. This is in addition to your standard land tax.
Oh, correct. Yes, sorry. The hints in the title is surcharge. In addition
Yeah,
to the base rate, you've also got the
yeah,
surcharge rate, where typically the base rate is now a smaller number than the surcharges. So, in Queensland, you're looking at 2.75%, but your surcharge is 3%. New South Wales is, I think, up to what, 4%. You've got a 5% surcharge now as well. So the surcharges themselves, and that's the same for stamp duty as well. The surcharges are now a significant, well, the majority of the total cost.
yeah. Like if I go back to that, the duty one, I could imagine paying what 5.5%, whatever it is in New South Wales now, stamp duty plus 9%,
Mm.
plus you might stuff up an acquisition or have a landholder duty issue and then pay duty again. There's one thing I know from my client, Sam, that they don't like paying duty. They
Yep.
definitely don't like paying duty twice. So getting
Yeah.
getting that structure correct, and managing that land tax piece again, it's an absorbent rate of tax. So
Yeah.
a lot of
So
care.
if we flick through, just appreciating time, might just make a couple of points on build to rent as well, just while we're on the topic of state taxes. So as a general proposition, various levels of government are trying to incentivize build to rent as additional housing stock. So obviously, you can have your freehold and townhouses and various other forms of housing stock, but build to rent is a fairly small niche area at the moment. Within the state tax sphere, they are offering various land tax concessions, and generally they're fairly long-winded or long-tailed concessions, so generally around the 50% mark. For developers of build to rent, they might be able to get exemptions from the surcharges that we've just been talking about. And there may even be a reduction or a concession around actually the full rate of stamp duty. One point I will note is quite often GST, I know it's not on the slides, but quite often GST is, I won't say the deal breaker, but it's probably the biggest tax issue in the sense that the GST that's paid to acquire, to construct, and then even operate the built to rent properties is usually non-recoverable. So there are various discussions being had at the Commonwealth level around ways that could be mitigated, but at the moment, GST is a real cost and has to get factored into feasibilities for these built to rents, which
Yeah,
is significant.
fully agree, Sam. And I think just on the federal tax position on this, like there has been withholding reductions and allowing depreciation and things like that have been introduced to kind of spark the interest in the sector. You're spot on though, that when talking with our clients, the single biggest inhibitor from a tax perspective is the GST. So everything's 10% more expensive. More fundamentally, the issue is also getting this to stack up financially. Now I know build to rent's big in lots of other jurisdictions. Seems to be hard slog here in Australia. I think the big end of town, there's some key players that are doing a bit in this space. But for everybody else, it's a BTR to S, and that's build to rent to sell. And so the conventional model, they've set up the entity, build it, lease it, run it, ultimately becomes a 6% return or a 4% return that just doesn't stack up compared to offloading the asset. So the acquirers or owners of these being large super funds or large listed entities that are looking for that long tail of consistent income as a revenue stream has probably got a bit more appetite to it. But they're throwing a lot of incentives at the sector. So really trying to move that along. One more question that's come through, Sam. Any concessions on surcharge duty or land tax for Australian-based developers, but that are foreign owned? So the answer is
Yes.
yes.
Sorry, I ran out of time to go through it, but yes, the answer is that if you are seen as a foreign developer who is contributing to the local economy, contributing to housing stock, there's different rules in different states. But yes, as a broad concept, there are exemptions that are available for Australian-based developers.
Yeah, my experience with those has been it's perhaps harder to evidence, at least in New South Wales. It's quite
Yes.
Don't assume that you're going to get in the provision.
It is a lot tighter now to get those exemptions than it used to be, because the feedback from revenue is that they've been burned a few times by giving away exemptions, and those projects actually don't go ahead, and then trying to get the land tax back
Yeah.
from the failed developer it's difficult.
Yep. All right. In the last couple of minutes that we have, I'm just going to touch on year-end planning, and I'll probably just touch on 2 slides here, and we'll just see how we go for time, unless any other questions come through. So now till 30 June, people with trust, year-end trust distribution minutes, making sure you do them, making sure you know who are eligible beneficiaries of your trust. All too often we see, deeds that are amended to exclude foreign persons from a trust, and then have that trust distributing to another discretionary trust that hasn't had foreign persons excluded under the trust deed. Unbeknownst to you, that other trust is no longer an eligible beneficiary of the first trust. So very, very cautious around, one, making sure your minutes are done, but make sure you read the deed and make sure that you know the parties are going to be eligible beneficiaries of your trust, particularly where you've had amendments made to exclude foreign persons. Division 7A loans from companies to shareholders or associates, which could include loans from a company to a trust. Making sure you've got your Division 7A loan agreements signed and in place, making sure you're charging interest, making sure you're meeting the minimum repayments, making sure that those minimum repayments are bona fide repayments and not caught under Section 109R. Looking at any kind of changes that have occurred during the year. All too often clients will say, oh, we've got all these tax losses, so it's fine. And we go, but we've changed shareholding during the year 60%, and we're no longer manufacturing X, we're manufacturing a variation of that, or something that's a bit different, or we've acquired something and we're getting income from something else, or we're doing a different property development, or we've gone from building and leasing to building and selling. All those things start to then potentially jeopardize your availability of losses. Anyone who's read the AFR over the last, call it 6 weeks, family trust elections and family trust distribution tax, hot topic for the ATO, and there's a lot of activity in this space. Either clients that have made family trust elections when they're not eligible, and therefore putting at risk their frank dividends that are flowing through those trusts and being able to get access to the franking credits at risk, or those who have made family trust elections and then made distributions outside the defined family group. And the definition of distribution doesn't just include who we're doing distributions to in terms of our trust minutes, but it can also include, for example, interest-free loans from a family trust with a family trust election to some party outside the family group. And that most people think, well, I've made a loan to, my son's entity's made a loan to my entity. If your entity has your family trust election on it and your son's entity has their family trust election on it, they're not within the same family group. So the devil is in the detail on this. And this is an area I think you're going to see a lot of activity from the ATO on in terms of family trust elections, family trust distribution tax, particularly because the ATO can go back as far as they want in terms of raising assessments on this. They're not limited to a 4-year amendment period. Putting those kind of key issues aside, looking at your lodgement, when are you due for lodgement? Most people go, it's either in March or May sometime. Go and check, because sometimes if you haven't been complied in a prior year, it brings forward your lodgement date for the current year. Also, if you're large, you could be due to make payment in December and lodge in January, which has always confused me with the ATO. We want us to pay first and lodge later, but that could be a December payment and a January lodgement, notwithstanding that you think it's due in March or May. So please do check. Be mindful of any kind of banking covenants and things that you're going to be reporting in your end of year financial statements, just turning your mind to them. Structuring, ensuring we're documenting any related party transactions, ensuring all our loans are having interest charged to the extent that it's needed under the loan agreements, considering whether or not you're going to form a tax consolidated group. You've got up until the date of lodgement of the tax return to consider whether you form a consolidated group. For any taxpayers that do have international dealings, the thin cap laws have changed. They're completely different. making sure you're compliant with all of those. If you do have, say, foreign ownership or an overseas subsidiary, and making sure you're compliant with FinCap, transfer pricing, any withholding tax obligations. For any taxpayers on the call that are significant global entities, one, congratulations. Two, you've got some onerous reporting obligations that you really need to attend to in a timely manner. We haven't seen any clients that are SGEs that have been hit with penalties that I'm aware of, but penalties for non-compliance are quite significant. You're talking $500,000 to $600,000 in penalties for non-compliance of a significant global entity. And then for others that are out there that are just coming to year end going, well, what do I do? Do I pay a dividend? Do I pay a bonus? Do I record up wages? Have those conversations to, get that the remuneration to the owners of the business in a tax effective manner, in a manner that is efficient and, not perhaps paying a dividend in lieu of paying some exorbitant wages or something like that. Something to consider just in terms of the year end as we come up to 30 June. I've got many more slides on this, but I might pause there given we're at time. Just wanted to say thank you to everybody for joining this webinar series. I think there's another one coming up in July with some of our colleagues. If anyone does have any questions, can reach out. If you jump on the website, you can find Sam's details and my details. Happy to take any questions or have a chat with anybody as needed. But that's it for us. So thank you for today.